Good afternoon, good evening, good morning, depending upon when you're watching this. So this is a very special private briefing and it's not for everyone. So if you're on here, it's because you got a special invitation and you're joining us live, or it's because I have sent you this video after the fact. We've got a special guest with us. Anthony is with Howard Capital Management. We're going to be introducing him in a minute, but I'm going to be talking about an investment opportunity that's not really for everyone. And as a matter of fact, I typically don't talk about it with our typical clients. Most of our clients are towards the end of their working career and are approaching retirement. And the investment that I'm going to be talking about this evening really isn't geared for people at the end of their career as much as it is for the people at the beginning of their career. So we're going to be talking about that, about time value of money, and we're going to go into some details on that. I know we've got a lot of young business owners, we've got some entrepreneurs, we've got some young doctors, some residents that are about to become attendings and about to start their careers in the medical field. We've got some current doctors that are already on the call here or on the webinar with us this evening, all interested in what is this that we're going to be talking about. Well, before I get into it, I want to emphasize this one more time. This is not for everyone. And it wasn't available prior to most of the folks that are going to be on this call or get this video. But it is something that is going to be available through us. It's a special thing that's coming out here. So one of the things that I want to talk about first is when we think about what we're looking at moving forward. When I think about younger investors, I think about long time horizons. I think about folks that have the ability to put money off to the side for 20 or 30 years. And then in 20 or 30 years, maybe access it. So it's not a short-term investment, what I'm going to be talking about this evening, but it is a long-term investment. And it is also a higher risk investment. So definitely not for everyone, but for the right people, this could be something pretty special. So one of our guests, I want to get him introduced, is Anthony Sherlag. And Anthony, are you on here with us?
Yep, I'm here, Chad.
Excellent. I'm going to go ahead and share your info up here on the screen. Anthony actually works with Howard Capital, and he's going to be talking to us a little bit about an ultra aggressive fund that is through Howard Capital. Now, Anthony has experience in the industry. He worked as a financial service rep. He's worked a lot with younger physicians and residents, and he had programs that were set up. He has now become a liaison to advisors to show them different types of projects that are available or different type of investments that are available. Howard Capital has a whole host of different things that are available, but really this presentation is just about their ultra aggressive fund, which we'll get into in a minute. But Anthony, thank you so much for being on here. And do you have the ability to share your screen?
I do. Yep, I can share right now.
Excellent. So if you would, I'm going to hand over the reins to you. I want you to talk just a little bit about who Howard Capital is, what they do, how long they've been around, and then we'll kind of go from there as we get into the details of what we're going to talk about today.
Yeah, absolutely. I really appreciate you having me on, Chad. So for all the attendees, I'm going to give you guys sort of a brief overview of who Howard Capital is and why we have partnered with a great advisor, a great firm like Chad has. I think first and foremost, what's important about Howard Capital is we've been around since 1999. So we have a pretty long track record of navigating all different types of market cycles. I don't expect you to read this whole snippet right here, but one thing that I think is very important is that Howard Capital is purely quantitatively driven. So we use a couple proprietary math-driven indicators to help us select our investments, help us decide when we should be in and out of the market. So a little bit different than some investments you may be familiar with. We're not market timing, we're not stock picking. Really what we're doing is we are gathering the quantitative data given to us through the market, and based off that data, we are making investment decisions. Now, this is kind of the man behind the magic. This is Vance Howard. He is our CIO and founder. So he's also our main trader as well. But wanted to touch on just a few points here. Again, founded in 1999, based in Atlanta, Georgia. And today we have about $5 billion in total AUM, assets under management, assets under management. And we have a full suite of investment products, but again, just like Chad mentioned, today we're going to be talking about the ultra aggressive model, which is certainly unique. And one of the points that is very unique about it is previously this was really only for accredited investors. Today, through our partnership with Chad, we're able to offer this at a much lower minimum. So previously, we had a minimum of about $500,000. Today, specifically through Chad and in his firm, we have a minimum of about $25K. So I'm going to be going over, again, the ultra aggressive model. Here we have a couple key points. What I think, is something that should be kept in the back of your mind is that this is really our swing for the fences sleeve of a portfolio. This can hold 100% equities, but you'll also see that because there are some leveraged positions, double beta, triple beta ETFs, this has the ability to hold more than 100% equities. It is really the alpha seeking satellite position of a model. It's been around since 2015. And again, another point I want to make sure to stress, this is a minimum of $500,000 really in an accredited investor portfolio. But today, through our relationship with Chad, able to offer this at 25K.
All right, I'm going to pause you for a second there, Anthony. A couple things that whenever, and I don't want people to get lost in the lingo, so I want to take a moment and kind of lay out what we're talking about here. So one of the things that I talk about for younger investors is you have the ability to be aggressive. You can go after it because you've got such a long time horizon. You've got a lot of time before you're actually going to retire. So one of the things that I think about is, if we're going to be super aggressive in anything, we gotta figure out this is not for all of a portfolio, but maybe for a portion, and it gives us the ability to be super aggressive. Well, a lot of times when I'm talking to attending physicians or young physicians who are about to enter into their contracts and go from making $50,000 a year to maybe $300,000 a year, one of the things that we focus on is where can you put some money off to the side to maybe try to get better returns than what, say, the S&P's doing. So we want to kind of leverage your returns. Well, in the past, it cost $500,000 to get into this. So for most of my younger doctors that were entering into nice contracts, they didn't have $500,000 lying around. The people that this would work for were the people that had $500,000 that they really wanted to be aggressive with, but were towards the end of their careers, which is a little bit towards the opposite of the philosophies that I get into when it comes to having money for retirement. So one of the neat things that we're able to do is through the relationship that we created, we can actually start this at a $25,000 account minimum. So that's something very unique that I wanted to touch on, even though you did. But once again, this is a portfolio that, if Anthony, I think your next slide is going to show us what the history of this has done. And if you would, I want you to talk a little bit about that, because one of the things that I'll talk about is my investment into Howard Capital and how we came to find you guys and all that kind of stuff. But I want you to touch on what's been the history of this fund and how have you guys been so successful with it?
Yeah, so absolutely. So this has been around since 2015, and I think one term everyone is familiar with is hedge fund. And I don't think a whole lot of investors are super familiar with what that is, but this essentially operates very similar to a hedge fund. What we'll do with this model is we may hold a leverage to give us more equity exposure, and we also may move in and out of the market. So I think a great example right here would be 2020. The S&P in 2020 returned, I think it was around 21, 28%, somewhere in that range. And you see this model returned actually over 81%. The way we were able to do that is by following our trend analysis, by using the quantitative data. When we see significant market downturns, we will begin reducing equity exposure in this model. So you can imagine this model running 100, 140% equity exposure. When the market is beginning to draw down, we will reduce that equity exposure and we will enter into either short-term treasury bills or just cold hard cash. And the whole idea behind that is, hey, let's not experience all of this drawdown. Let's move to cash so that when the market does begin to turn around, we have some buying power in our back pocket. We can pick up positions that have been really, really beaten down. So 2020, when the S&P was drawing down pretty significantly, 30, 35%, we were in a cash position, similar to right now. Right now, this model is in 100% cash. So the way that we're able to achieve a lot of these returns is, one, by moving to cash, two, by using that buying power when we get back in the market to really excel performance forward. And three, of course, is by using some of that leverage.
So one of the things that I'm hearing is you mentioned being 140% in equity. Now, people hear numbers like that. Hey, you can be 100% in stock. How are you being 140? And that's really where you're talking about how you leverage your investments.
Exactly. So we will use inside the model, we will actively trade some leveraged ETFs, double beta, triple beta ETFs. So, an easy way to think about that is if we are holding a triple leveraged S&P fund, for example, if the S&P goes up 1% in one day, typically a triple leveraged ETF, S&P ETF, will go up 3%. So certainly that can be very, very volatile. And that's where on the downside, we will reduce risk. But on the upside, it can be a really amazing vehicle to generate returns. Like you see 2020 returning over 80%, 21 returning nearly 60%. You'll see some pretty big numbers on here. But keep in mind, it certainly can be volatile. Year to date, you'll see it's down almost 30%. But we use some pretty, I guess I would say advanced strategies to limit volatility on the downside as much as possible and capture as much of the upside as possible. And that's why I think.
So as of right now, I will tell people that, and I'm okay sharing this, I'm in this ultra aggressive portfolio. I actually got into this ultra aggressive portfolio after seeing a presentation that Howard did last year I think it was in September. So Nathan and I began doing our research, our due diligence. I got into this fund. One of the things that I talk about is I have a long time horizon. I've got 20 years. I'm planning to work until I'm 70. So I've actually got 21, 22 at least till September. Then we got to say 21 years of work life left. So short-term gyrations in the market don't bother me as much because I know the markets will come back up eventually. And I'm okay with taking on extra risk, but not everyone is. Not everybody is okay with seeing the kind of movement that we see here. So year to date, and this slide's a little dated, it's as of April 30th, but as of right now, this fund, I believe, is down right at 30%, 30.8 if I'm not mistaken. So as of right now, I'm down 30%. Our clients who are in moderate portfolios are down about 8 to 10%. Even my aggressive portfolios, I think, are only down about 18 to 20. The S&P right now, I think, is down about 24. NASDAQ's down around 32. This portfolio is down that much. So it is something that is very aggressive. But what I'm looking for is, what are the years when the S&P did 20% and they did 80? What about last year when the S&P did closer to 26 or 27 and they did 57? What about 2019 when they did 36%? So 2017 at 65. So this is one of those accounts that right now, since inception, has been averaging 22. How long can they keep that up? I don't know. But that is definitely the power of leveraging. It leverages to the upside. It can leverage to the down, which is where your proprietary buy and sell type system, where you're trying to get out of the market, you're doing more of the market timing. And can you talk a little bit about your buy line? You mentioned that, but I know people that are on here, I'm familiar with it, but the people that are on this may not be. Can you give us some? Yeah, perfect. Can you make that full screen for us? Hit your little slide presentation button there on the bottom right. That would blow that up a little bit for us, I think. That good, thank you. Can you go through that for us?
Absolutely, absolutely. So the HCM byline is Howard Capital's proprietary stop loss risk management indicator. So what this is going to do, again, it's not necessarily market timing, but what we are doing is we are following our trend analysis, and we are using several quantitative factors to determine when we should or should not be in the market. And first thing you'll see is this is certainly not a perfect system, but it is emotionless, it is mechanical, and because of that, we believe it's a repeatable process. But the way this works is when the S&P begins drawing down, as it passes through our indicators, when it falls 3.5% below our first indicator, which is where you see these yellow lines, yellow diamonds, we will begin reducing equity exposure. So we will begin moving to a defensive position inside of your portfolio. And that can be up to a 50% move out of the market. When the market continues to draw down and we pass our second indicator, that is where you will see these red diamonds. And what that means is that means we have further reduced equity exposure. So I think I definitely want to point out 2008 and 2020. 2008, our ultra aggressive model was not around, but we certainly had a few other models that we were managing at that time. One model ended the year about even. One model ended the year down about 7%. The S&P that year returned negative 37%. So I think what that means to you.
You cut out on me, Anthony. Say that again.
So
in 2008, the S&P returned negative 37, and your models did what?
We had one model that was about even on the year, and we had another model that was down about 7% on the year. So, what that really means to you is you are recovering from those recessionary type periods, those dramatic drawdowns a lot quicker. Just to give you an idea, it took the S&P about 6 to 7 years after 2008 to return to even. Our models took about 6 to 7 months. So you see where that value is being provided. In 2020, we had about a 15, 20% drawdown in a lot of our models. The S&P had about a 35% drawdown. So we were able to buy a lot of those positions that had been really beaten up for discounted prices, essentially. So the way this works, what I think is really important to you is one, again, purely quantitative, not a perfect system, but historically has performed very well. And all we're trying to do is mitigate those drawdowns so you don't have to experience something like 2008 and say to yourself, hey, well, now I have to work an additional 8 or 9 years. That's really the whole goal of this, is to sidestep some of those recessionary periods and deliver better performance than what the S&P is.
Okay. All right, I'm going to shut off, or if you would, I'm going to stop your sharing. I'm going to do a quick screen I'm going to do a quick screen share of my own. So one of the things that I want to look at here, and let's see if I've got this right. Maybe you can tell me if you can see my notes or if you see the full screen. I'll just redo it. We are recording this, so this will be very clean on the recording. So I'm just going to stop with your screen share and I'm going to share my screen. One of the things that I think about is if I'm going to be an aggressive investor, I want to think about volatility. So I use this as an example. I've used this lots of times over the years. I've got two people that have invested, James and Heidi. Jim and Helga is what I call them, but $20 is what they bought ABC stock for. 1 year later, they both sold the stock for $22 a share. So what am I looking at? Well, Jimbo checked the price every single day. Some days it was up, some days it was down, it was up. He's calling, hey, what do you got going? Oh, should we sell? Oh, let's buy more. Oh, should we? Hey, maybe we should get out of it. What's the best time? And at the end of the year, he's like, oh my gosh, we sold it. We finally sold it at 22. Heidi didn't look at it. We bought it at 20 a year later. We sold it and she goes, oh, it's $22. Okay. Who had a better experience in the market? You should be saying Heidi did. Really, the experience is how often we check it. Market movement itself isn't smooth. And when we start talking about a leveraged fund or leveraged money, that's even choppier. That's a bigger roller coaster. One of the things I point out to people is if you're going to be an aggressive investor, it's really a matter of time. So I ask people all the time, which portfolio would you rather have, portfolio A or portfolio B? Everybody right now should be saying, I want portfolio B, because you can see it goes from the bottom left, it has an upward trend. Portfolio A does not. But here's the tricky part to this. Portfolio A is actually a subsection of Portfolio B. Really, Portfolio A is from October of 09 to June of 2010, and Portfolio B is from June of 09 to June of 2013. So you really have to understand volatility. If you're going to be an investor who is aggressive, that means you have to understand that market volatility really isn't your volatility. It's going to be a function of how often you look at it. And a good financial plan accounts for volatility. So you think about market timing. So if I'm going to have somebody market time, that's what I'm using Howard Capital for. But even inside of market timing, I'm thinking in terms of time in the market. If I were to look at Howard Capital's performance year to date, they're down 30%. If I were to look at their performance over the past 7 years, they're up over 200%. So it's really a function of how often am I looking at it. One of the surveys that was done in 1963 to 2004, it was done by Forbes, and that was 42 years, 15,000 days. And if you were just in the stock market, if you were in the stock market, you averaged 11% a year. Well, what was interesting was they took the 90 best days out of the market. And if you were in the market for that same time, but eliminated the 90 best days, your market return was only 3%. So over the course of 42 years, less than 1% of the trading days accounted for over 96% of the return. Why do I tell people this? Why do I have it in 3 different slides, the exact same point? Because really it is a function of timing. You know, I love how people can look at 1 day, 5 days, 1 month, 6 months, a year, year to date. Who has a time frame that is 1 day, 5 days, 1 month, 6 months? If you're planning for retirement, for the younger investors that I'm talking to or who this presentation is geared towards, your retirement's 30 years out. And guess what? People turning 100 is one of the largest segments of our population. You get to retirement at 65, you got another 30 years of life. We're living longer, so our money has to last longer. So you shouldn't be watching your portfolio as what is it doing every single day. You find a place, find a company that can leverage money for you, and then you let them do their job. So one of the things I look at is your retirement 6 months long. See, here's a 6-month Dow Jones over 6 months. How long does your money need to last? Here's May 8th from 2015. We look at 10 years. Let's look at the max. We can see what happens in the market. So you got to stay focused on long-term planning when it comes to the markets. So now let's talk a little bit. Screen sharing stopped. Good. Let's talk a little bit about where this would make sense. All right, so we now have the ability to get into a leveraged aggressive. That's why it's called ultra aggressive portfolio. Now, what should we put in an ultra aggressive portfolio that we're really trying to knock it out of the park? Should we be putting in all of our money? No, the answer is no. You should be carving out a portion of your money. Well, what if we put in 25,000 as a starter? Well, where would I want that money to come from? So my younger investors, the first place that I want to take money from is a Roth account. A Roth account is a tax-deferred and tax-free account. So your income has to be under a certain level, and you can put $6,000 a year into a Roth. You can put money into your 403Bs, your 401Ks. You can put money into brokerage accounts. But if I was going to put any money into this, my number one choice would be a Roth account. Why? Because if I'm going to try to make 20, 30, 40, 50, 60, 70, 80% in an investment, I want it to be in an investment that I don't pay taxes on in the future. That's first and foremost. Number two, a Roth account for my younger investors. You can't get to that money until you're 59 and a half. It is set up as a retirement account. You can get to it. You have penalties and things like that, but it is a retirement account. So any money you're putting into a Roth is money that you're trying to set aside for retirement when you're in your 60s. That means you get 30 years of growth. The power of compounding is incredible. Compound interest, I think Einstein said it was the eighth wonder of the world. Those who understand it will profit from it. Those who do not will pay it. So let's say that we don't have enough money in our Roth. What's the second thing that we should put in it? Should it be our IRA money, or should it be 401k type of money? Well, that's money that you are deferring your taxes until the future. So show of hands, how many people think taxes are going down in the future? My hand is not up. We are currently, as a nation, trillions upon trillions of dollars in debt. And they're going to have to pay for that at some point. When and who? Everybody says, well, how are they going to pay for that? It's the wrong question. The true question is, who's going to pay for it? It's going to be the people that have done a good job of savings. And most people's money is saved in pre-tax IRAs and 401ks. They're deferring the taxes until the future, when guess what? Taxes are going to be higher. Interesting concept. So not necessarily a place that I want my IRA money, but money outside of an IRA, that would be a brokerage account, a normal brokerage account. That would be a good place, because any gains that we get, we would pay long-term capital gains tax on. So once again, let me be very clear. This type of investment is not for everyone. It is for younger investors who are willing to take on more risk, who understand that there are going to be ups and downs in the market, but you have a long time horizon. And historically, the longer you are in the market, the better you do. Now, what is the market going to do tomorrow? What's it going to do next month? What's it going to do over the next 6 months? I don't know. Somebody comes up to me and says, hey, what do you think the market's going to do? And I always answer, it's going to go up. And they go, oh, really? You think, with everything that's going on? And I said, you didn't give me a time frame. They said, what do you mean? I said, you didn't give me a time frame. What do I think the market's going to do? I think the markets are going to go up. Do I think they're going to go up next month? Well, I don't know. 6 months? I don't know. Next year? I don't know. Over the next 5 years? Pretty sure. Over the next 10 years? I'm feeling even more confident. Over the next 20 to 30 years? Yeah, I'm inclined to say the markets are going to go up. So if I'm going to invest in something and be very aggressive, I have to be okay with the volatility that goes with that. Does that make sense? So when I'm looking at this investment, I'm looking at it for younger business owners. I'm looking at it for people who can afford to put $25,000 off to the side that they're not going to come back in 6 months later and go, hey, I need to get that out. If you have a need for that money in a very short period of time, you shouldn't be investing it. So when I think about investments, I think about you can take a portion of your portfolio and be super aggressive with it if you want, as long as that's the portion you're not touching. Any money that you're going to need to get to in the short term, you want to have that set up to the side in an emergency fund or in a much lower risk investment because you have a purpose or a need for it in the not too distant future. Any money that we're putting into an ultra aggressive fund, you need to be able to let it do its thing. And that requires you to step away when you're like I am and down 30% in the past couple months. Okay, that's fine because 20 years from now is when I'm going to need it. So I hope that's helpful for you guys. And now the next question that I get is, okay, well, if this is something that I want to do, how do I go about doing it? What's going to be the way to get this? So the easy way for me to describe this to you is that we can set this up so that, I'm not sure I'm sharing my screen right now, but let me try this again. Once again, when I do this back from the recording, it will go much smoother. So where was I? So one of the things that people will ask me is, okay, well, how do I get into this? Well, easy way to do this is going to be to call our office. We do have the ability to get into this investment, and Nathan is set up to take care of it. All you have to do is make a phone call and say, hey, I want to look at this. We do have the ability to do paper applications to get into this fund. We can also do it electronically. If you are currently a client, then we would be talking to you about how it fits into your overall strategy. If you are not currently a client of ours, that doesn't mean that we won't help you to get into this. We just want to look at everything else you've got going on to see if it is a suitable investment and to have a conversation with you in more detail around the risks associated with investing, and especially with investing in an ultra growth type of portfolio. So the easiest way to reach out, you can go to our website, Dispinit, WMG, which stands for wealthmanagementgroup.com. You can type in chaddispinit.com. You can type in wealthwithclarity.com. All three are going to take you to our website. You can Google search Dispinit Wealth Management Group, or you can simply call the number on the screen, which is 740-277-6172, and ask for Nathan or Chad. Nathan is the one that is spearheading this and will be helping us, helping our clients to move into this portfolio. If this is something that you think fits and is something that would help you, that you really want to try to knock it out of the park, then give us a call and we will work with you to get it done. At this time, if anybody has any questions, feel free to type them into the chat box, and I would be happy to try to answer any questions that you've got. If not, thanks for joining us for the presentation. If you're watching this as a recording, don't try typing into the chat box. There's no chat box for you. You'll just have to call to get your questions answered. With that, I'm glad that you were able to join us this evening, and I look forward to talking to you guys in the not too distant future. With that, continue to stay focused on the long term, continue to take action upon the things that you learn, and God bless. I'll talk to you soon. So right there is where I'm going to stop it for the presentation. But for everyone else, if you have any questions, you can type them into the chat box, and I'll be happy to answer them for you. Here's a good question that we got. What if I don't have $25,000 in my Roth account? That's okay. If you don't have $25,000 in your Roth account, you may have it there in a year or 2 or 3 years. This is something that we're hoping we can keep around for a while, and it does give us another option for some of our younger investors. Mainly we work with much older investors, but we have a lot of kids of clients, and we've now got quite a few younger doctors that we've started to do some educating. So might take you a couple years to get there, but this is a piece that we could look at for you. Great question. Thank you for asking that. Another question. That's a good question. Is it have to be 25,000 in just one account, or could it be our 3 accounts added together get to 25? No, this is an investment that needs a minimum $25,000 in it in order to qualify. So if you have 12 in one account and 13 the other, that doesn't count. It has to be in that particular account. And quite frankly, that's a very low threshold for a lot of firms, and their previous threshold was 500,000. So it's quite a unique thing that we're able to get this done, and it's part of the solutions we've been looking for our younger investors. So we're pretty excited about it. Nathan and I both are, and that's why we've got our own money in it. Good question. All right, I'm going to wait around another minute or two if anybody else types anything in. If not, you guys have a great evening and an even better weekend. I will be leaving town on Sunday for a family vacation and back in a couple weeks. So Nathan will be able to answer any additional questions that you've got. Feel free to call in, and he can help take care of those questions for you, and be happy to get you set up if this is an investment that you're interested in. 10-year outlook. All right, I got a question here. 10-year outlook. I assume you're asking me, what is the 10-year outlook of the markets? Yeah, no, 10-year outlook. I think there's one 10-year period in history, they call it the lost decade, where the markets did not go up. And I believe that was somewhere around 2000 to 2010 or 2009, something like that. So you had you had a lost decade in there because of 08, 09, the market dropped, I think over 50%. And of course, you go 1 year past, the market came back 70%, I think in 2009. But there's one 10-year span that we can pull out where the market was flat. So I'd feel pretty confident to say our 10-year outlook is pretty good. Very good, very good. All right, guys, have a wonderful evening. We will talk to you soon. Take care. God bless.